here's everything you need to know for the ultimate reversal setup on edgeful.com. So starting out with the home page, I highly recommend that you guys watch these 3 videos. These are going to be extremely helpful if you trade futures, stocks, options, literally anything, crypto, Forex. These will be very helpful for your understanding of edgeful as a whole. In this video, I'm not going to go into those details. I'm going to focus on 4 reports that are extremely high probability, and when they set up together, it is an A+ setup. So let's go to this chart example here. And the first thing you're going to notice is these blue boxes. These are the market sessions. This is the New York session, and this is the market session indicator that we have on edgeful.com. If you want access to these, what you can do is on the right side, right over here, you're going to see this Trading View button. You can click on this Trading View icon and put in your Trading View username, which is, you're going to put that right over here. The way that you find that is you click on your profile button at the top left of Trading View, and then you're going to see your actual username right over here. And then once you put that in, click update, and then in your indicators, you're going to see this invite only appear and all of the indicators here. The one that I have up right now is the market sessions. This is really important. If you trade futures, Forex, or crypto, I highly recommend having this in your charts at all times. Super helpful just to outline what the New York session is. Now, it's very important that you know what the New York session is because of the way that edgeful calculates and the way that these reports they work. So looking at YM in the last 6 months in the New York session, which means that we are literally excluding all of the data here, because it's not within the 9:30 to 4 p.m. price action. We are looking exclusively here. So if we're looking at these 2 days, this will be today. Previous day's low is right over here. Previous day's high is right over here. Previous day's open is the open of the New York session. Previous day's close is the close of the New York session. That is because we are filtering for only the price action within the New York session. Now, let's go over some of these reports that you need to look for and pair to build this setup, starting with the gap fill. The gap fill is when price today opens above or below the previous session's closing price. So in this case here, we're going to this New York session. I want to plot out the closing price of this session. So I'm going to make this red. This is my gap fill. This is my previous day's close. And you can see today opened above, obviously, right over here, opened above this red line. So that would make it a gap up. So you can see in the last 6 months, almost 70% of gaps up have filled, which means you want to have a short bias targeting price to come down and touch this previous session's close or this red line. So looking at it like this, you want price to come down and touch this previous session's close at some point in this New York session. Now we're going to move on to a few other ones before we get into really the setup first. So next, what you'll notice here is, and I'll go to the next report, it's called the outside days report right over here. If you want to go and look for these, you can search for them right over here in the sidebar. This is number 4 in the sidebar. You can just type out outside days and it'll come up. Make sure to click on that. Now what you're going to notice, what an outside day is, first of all, is when price today opens above the previous day's high, previous session's high. So I just outlined previous session's high. That is a bullish outside day when it opens above. If it opens below previous day's low, that is a bearish outside day. So very obviously, again, which I'm going to plot out in green here, today's open is above the previous session's high. What you can see is that 64% of bullish outside days, which is when price opens above yesterday's high, have reversed back down into yesterday's range. So in this case, we're not targeting the previous close. We are targeting this yellow line, which is previous day's high. So we want to expect price to come down into previous day's range, previous session's range. Next is the ICT opening retracement. Now, some people like ICT, some people don't like ICT. All that matters is that, and we have an indicator for this one, ICT opening retracement. You can see right over here. Let me make this orange. Actually, the blue is fine. You can see all this is saying is instead of being previous day's high or previous day's close, it's saying what is the midnight opening price. So you go to the midnight candle, midnight Eastern time, you go to the opening price of that candle. That is what this report is saying. How often does price reverse? When it opens above in the New York session, when does it reverse back down to touch this point right here? You can see 77% of the time, this will happen in the New York session. So again, we have 3 reports that are bearish. And when this happens, when price opens here above all 3 of them together, this is a great reversal setup. We've been talking a lot about continuation setups with the ultimate bullish setup. If you're interested in that, you can go to the home page and watch that video right over here. This is more continuation. And then if you want to go to right over here, this is going back to the ICT opening retracement. Now, you can see 77% of the time, price will retrace on YM. Now, this is going to be very different for every single ticker that you're looking at, so please be mindful of that you need to check this on the tickers that you trade. This data is also going to change. So every day there's new price action, every day the market is changing. Edgeful will keep up with those changes. So make sure that you go and you look at the data that you need to look at for these reports. So whether you trade ES, gold, oil, NQ, whatever it is, you need to make sure that you check these. They're not going to be the same across the board. Now, here we have 3 reports that I would say are very strong. Like I would require these for, if it's going to be this ultimate setup, if it's going to be this A+ setup, I would need price to open above all 3 of these. The last one is going to be the weekly open. And this is really only going to apply on a Monday, but the weekly open is a 4th one that you can use. Weekly open. This is one that you can use. And I'm going to change the color to be purple. And I'm going to zoom in a little bit. This is one that you can use mostly earlier in the week. And we're going to go to the weekly open report. Weekly open report. And what you can see is that for every time price has opened in the New York session above the Sunday 6 p.m. close. So by the way, this is the only report that will consider the 2 reports that will consider the overnight range. Obviously the ICT midnight open is referencing just this single candle. And then the weekly open is referencing the Sunday 6 p.m. price. What's very important that you guys do is you watch these videos that are down here. We don't have one for the weekly open right now. We're going to upload it soon. But if you were to go to the gap fill, for example, and scroll down, you're going to see this explanation video. It is extremely crucial that you guys watch these so you understand from start to end what this does. Played at 2x speed, they're at most 10 minutes. So like it's not that much. It's not like a 2-hour course. They're at most 10 minutes played at 2x speed. I don't really care, but you have to watch them. So weekly open. What you can see is that almost 80% of the time when Monday has opened above the Sunday 6 p.m. price, at some point this week, price will retrace to touch this purple line. Now, if you go to the bi-weekday version of this, you can see that of every time price has retraced, almost 80% of the time it's been on that Monday. So Monday, if you are going to use the weekly open, Monday is the day to do it. Otherwise, you don't have to use the weekly open and you can just use the outside days, the opening retracement, ICT opening retracement, and the gap fill. Okay. So, obviously, your bias here is going to be bearish because you want to expect price to reverse downwards. Your targets can be each or any of these lines or this area. So, any of these or this area is a great place to target or to take some of your position off. You can hold runners for continuation of the downside, but what the reports are measuring are only if price will reach this area here. Now, in terms of the entry, let's look at the gap fill by spike. So I'm going to my gap fill report. I'm going to by spike. And what this is looking at is in the last 6 months, what is the average move up before coming down to fill the gap? So right here we have the gap up. So these are all the gaps up that have filled. And then down here we have all the gaps down on YM. So what you can see is that the average gap up is $61, 61 points specifically. So on this day, we're using, this would be the average spike right over here. So it's referencing points like this. If you want to measure the points yourself, you can use this measuring tool on TradingView and you can just click from the opening price, 60 points higher. Now, what's important about the buy spike is that it is taking the average. That means some of them will be below, some of them will be above. So this is and the way to think about this spike is if you were to enter right at the open, this is the drawdown that you have to expect if you were short. So in this case, if you entered short right at the open, the average drawdown that you're going to be in before price comes down to fill the gap or touch this red line, specifically this red line, is going to be 61 points on the YM. Now, in this case, there's two ways to do it. You can enter right at the open. Personally, not a huge fan of that because it can go further than you want, but you can enter at the open. In that case, you have to leave a very wide stop. Typically, you can use a lot lighter size, but you can enter because there will be days where it just flushes and it doesn't spike, which is fine. Or you can wait for the spike, you can wait for the bounce, and then now look for an entry up here. That's gonna increase your R multiple, your risk to reward, and you won't have to leave as wide of a stop. Now let's go to the outside days. So pretty much, just before I do that actually, pretty much the way that this works is you want to wait for at least a bounce of 60 points away from the gap fill. So on a gap up, we're looking for 61 points roughly. So on a gap up, we want to wait for 60 points upside before we start to look for an entry. And then this is where you can start to look for your entries. Next is the outside days. If we go to the buy spike here, you can see that bullish outside days, which is what we're looking at here, it means price opens above this yellow line, above yesterday's high, previous session's high. The bullish outside days, in this case, the average spike up before price comes back down to touch this yellow line is 83 points. So again, we're going from the open up 83 points. And now this is where you should expect to look for your entries. So now when you combine the gap fill by spike and the outside days by spike, you know that roughly the move away from the open will be 70-ish points, 80-ish points, maybe a little bit more, maybe a little bit less. But this is the zone or the area where you want to start to look for your entries. And that's what the data shows. It's not what I'm saying. This is what the data is showing. So in this case, entering short somewhere here, targeting this area down here, and then you can place your stop. Now in this case, there is no, and one thing that I don't really like to do, to be honest, is base a stop on a random R multiple or whatever else, but you can allow for some more room to breathe based on the spike. So in this case, the actual spike here was 115 points, 117 points. So if we enter or we start looking for our entry around the 80, 90 area because of the spike of these two reports that we just covered, now you can leave another 20 points or whatever it is, whatever you're comfortable doing, 30 points, targeting this area here. So you can use the buy spike as an entry and as a stop. In this case, we're using it as the entry and as the stop slightly because we're saying if we know that the average spike is 80 points, but it's at 200, that's invalidating the trade. So in this case, what you can do is enter after the spike occurs, somewhere in this blue box. This is the area of the spikes. And then now you can expect price to flush to these different points. Now, it's not always going to be where they're all so close together. Sometimes the gap fill can be down here. Sometimes the midnight open could be down here, which gives you further levels to take profits. Now, in this case, they are pretty close, which is totally fine because it gives you a stronger key area to take your profits. Now, you can always leave runners. In this case, you probably would have, on this bounce here, you probably would have gotten stopped out at break even. But this area is the one to take the trade. And of course we care, but we don't really care about this move here. The reason for that is that these moves are very unlikely, typically. These gigantic moves down where it's just this continuous selling is super unlikely. As a trader, you want to be consistent. You want to go for singles. You want to go for doubles, like batting for singles, batting for doubles. You do not want to be swinging for the fences all the time. You want to make sure that you have consistency, that you are going for high probability trades. This here is a high probability trade. Even if you enter with very light size at the open, with a wide stop, looking to add at the spike, which is this blue area here, this blue box, this is a great trade setup. Even if you were to leave some money on the table here as price flushes, that is totally fine. Because as traders, we focus on high probability setups. We execute when they form. We execute on them based on data. We have data-backed bias, which is super important. The levels where we want to take our profits, obviously very important. Our entry and our stop are data-backed. Super, super important here. This is the ultimate reversal setup. Again, you do not need to consider the weekly open. So you can actually take this trade more than once as it sets up throughout the week. The weekly open is realistically only going to set up on a Monday. And in this case, when you see these, so again, recapping, bullish outside day. So we're looking, and this is all going to be in the what's in play, by the way. So let's go to the what's in play 1 second. The ones that you want to have is the outside day. We're actually going to be adding the right over here. So I guess, where is it? The outside days. So in this case, we're going to be adding the ICT opening retracement. That will be the other one. So you can just go over here, have these three up, and then now you can see, okay, gap up, bullish outside day, and then ICT opening retracement. You're going to see these here live with all the key levels plotted out for you with the bias, with the levels, with the distances, with the gap sizes. And one thing that's very important about outside days and about the gap fill is the sizes. So you can see here that the gap size is pretty big. So what we're going to do is we're going to go to the gap size right over here. And I'm just going to show you quickly, I'm going to go through these quickly, and I'm going to show you how the gaps fill less and less often as the gaps get bigger. So let's say that price today opened up here, which would be a gap up of 1.6%. In the last 6 months on YM, it's only happened once, but it's not going to reverse. Pretty much. There's an extremely low probability that price is going to reverse. You do not want to go for this when there is a giant move up overnight. You do not want to expect something like this to happen. You want to go for this when the gaps are smaller, when the probabilities here are in your favor. Maybe between 0.4 and 0.6, I guess not. Below 0.4 is really the area you want to go to, specifically on YM. Now, again, the data is going to change for whatever tickers you're looking at. Make sure to check out the tickers, or if you trade Tesla, if you trade NVIDIA, if you trade options, if you trade futures, Forex, or crypto, it doesn't matter. All of this translates perfectly to each of them. Just make sure that you are paying attention to the data and the stats, and we will tell you all the information you need up top in the What's in Play and on the What's in Play page. Every single day, it will set up for you here. and then you can go and customize these. If this video is helpful to you, please subscribe to the YouTube. We have a ton of information on there that will help you become profitable. Also, on the right side here is our support. Always reach out to our support with any questions that you have. We will answer you immediately. Thank you for watching. Have a good one.